Calculating land and building values for tax purposes is an essential step toward maximizing your available tax deductions from depreciation. This is because the law says you can only depreciate items that wear down over time. That would be the building, but not the land the building sits on. Since most real estate purchase agreements don't assign value to each category, building owners, investors, and their tax professionals really need to understand what options they have in coming up with a proper allocation to land and building. Stay with me and I'll show you 5 of them. In many cases, buyers will have a real estate appraisal completed for the purpose of getting financing, but that doesn't often include a separate value for the land. In cases like this, where the purchase price is significantly high, it might make sense to contact the same appraiser to conduct a land appraisal. For income tax purposes, every dollar that can be shifted from land value to building or improvement value will gain you permanent tax benefits. Taxpayers are required to separately identify the value of non-depreciable items, which would be the land, from the depreciable building and improvements. If a full scope appraisal showing the land value wasn't completed during the purchase process, here are 5 options to determining the depreciable basis of the building that taxpayers may reasonably consider. I specify reasonable because taking a wild guess, which some have done, is not reasonable and it might get you into some hot water with the Internal Revenue Service. Rely on the county tax assessor's allocation. A taxpayer can look up their county tax assessor's property allocation, which usually provides an assessment of land and improvements based on the county's guidelines. This allocation can be found on the most recent property tax bill or on the county assessor's website. The values listed there most likely won't match the total acquisition cost, but you can use the ratio between land and improvement values and apply it to the total purchase price for income tax purposes. While the property tax allocation method is the most commonly used and generally accepted by the IRS, it's not always the best indication of fair market value. If you think the proportion designated to land is unreasonably high, you might consider one of these other options. Second option is to commission a full scope land appraisal. A qualified professional appraiser will generate a comprehensive analysis considering factors such as sales comparisons, highest and best use, market conditions, and income generated following the uniform standards of professional appraisal practice guidelines. While this option is the most accurate land valuation that you can get and the least likely to be challenged by the IRS, it's also the most expensive and it can take several weeks to complete the process. You can also try a limited scope land appraisal. A limited scope land appraisal can be completed by a real estate professional who provides an analysis of sales comparisons or other limited metrics. Similar to the broker's opinion of value, this analysis is less detailed and may not follow the USPAP guideline. Also, a replacement cost method. This methodology is supported by a 1982 court case, Myers v. Commissioner, where the taxpayer successfully argued against the property tax assessed value allocation. In this approach, the taxpayer calculated the cost to construct a new building, say $300 per square foot at 2,000 square feet, totaling $600, should be allocated to building, and the remaining balance of the acquisition cost should be allocated to land. Whatever value is used must be reasonable and in line with market conditions. The tax court in that case felt the tax assessor's allocation didn't show any evidence to comport with reality, and the taxpayer's estimate was much closer to the truth. This property was acquired in 1977 when real estate values weren't as inflated to the level we see today. If a property sells for a significantly higher than replacement cost of the building and land value, the strategy doesn't work quite as well. And then lastly is the rule of thumb method. Some taxpayers use a predetermined percentage, like 80-20, for improvements and land. Most tax professionals don't advise their clients to utilize this approach, and it may raise concerns under IRS examination. This was highlighted when the U.S. Tax Court released Summary Opinion 2017-31 in May 2017, concluding that a county assessor's allocation to land improvement values was much more reliable than the taxpayer's proposed values. The tax court noted it could not find any authority that suggests a taxpayer is qualified to allocate the value of property between land and improvements. If a client owns multiple properties similar to the one in question in the same geographic region with established land values, some taxpayers have successfully utilized an average of the building and land allocation percentages to apply to the newly purchased property. When land and buildings are purchased for one price, taxpayers can and should advise their clients on the pros and cons of using various approaches to allocating the cost for tax depreciation purposes. Relying on property tax assessments for this information may result in leaving deductions on the table. In situations where the county tax assessor's land value is excessive, considering these other options can yield significant permanent tax benefits that can be further enhanced by an engineering-based cost segregation study. Contact me with any questions you might have on allocating land versus business values and the tremendous opportunity the quality engineering-based cost segregation study affords you in tax savings by accelerating the depreciation on your commercial or investment properties. Thanks for joining me on today's video. I'd really appreciate your taking a moment to leave me a comment or question down below and a big thumbs up on this video. And if you'd like to see more videos that can help you boost your cash flow, or you'd like to be notified when I do my live broadcasts, Mr. Cashflow Live, go ahead and subscribe to the channel and click on the notification bell, and you'll be notified each time. I'm David Weiner, the CEO of Cashflow Strategies. After all, it's your money. Keep more of it.